Welcome to the second video of Fayle Safe Wealth. In this episode, we're going to cover how to diversify your portfolio and pretty much limit your risk of loss. Okay, so let's jump right into it. So there's several ways you can diversify your portfolio. One way would be if you just want to invest in stocks, invest in different sectors. So you have like consumer staples like your Coca-Cola, or you have like AT&T, which is like your communication sector. You have your tech stocks, which would be like Microsoft, Google, or something like that. And you have like health stocks, which might be like Pfizer or Roche, companies that you might have heard of. I don't know. But one of the best ways in which Okay, I'm just going to apologize now for the weather. I have no control over that, and I was doing the best I could with what I was working with. So, well, you know what? Screw it. I'll just give you something better. So back to the matter at hand. So diversifying your portfolio could be relatively easy depending on what you're looking for and how much time you have. So you have mutual fund, index funds, ETFs, and REITs, and those are pretty much similar in a lot of ways, and they only differ in small little ways. And then you have bonds for if you want to selectively pick your stocks and pick your bonds and diversify your portfolio on. But if you don't have time for all that and you want to pretty much just invest and not have to look at your portfolio, I would recommend a mutual fund or an index fund. And the reason why I recommend those is because with a mutual fund, it's a basket of stocks. It's actively managed. You have a person that's going to buy and sell stocks for you, pick stocks. You can have aggressive mutual funds, growth mutual funds, value mutual funds, and you have mutual funds that has a target date of retirement. So let's say you pick a target date of 2045. So based on the year it is now, you'll have more stocks, less bonds, and the closer it gets to that retirement date, you'll have more bonds and less stocks. But one thing that you want to look for with all of those are expense ratios. So pretty much an expense ratio it's pretty much the cost of doing business. It's what you're going to have to pay out of how much money you have invested into those funds. So with a mutual fund, it is a bit higher because you have a person that's actively managing it, but you probably don't want anything over a 1.2 in my opinion, and that's pretty high. So if you have $100 invested in a mutual fund, $1.20 will be 1.2%. With the index fund, since index fund is pretty much a basket of just stocks and they passively manage, meaning they just pretty much track indexes that's already out there like the S&P 500, the Dow Jones, and the NASDAQ. Since they just track those indexes already, you don't have to, it's not actively managed. So an expense ratio for those might be 0.2%, which is really cheap. So if you have $100, that's like 20 cents out of that $100, and depending on how much money you have in it. And now the difference is between an ETF and a mutual fund and an index fund is with a mutual fund and index fund, you can only buy in or sell shares at the beginning of the market opening or when the market is closing. You can't trade them throughout the day. With an ETF, you can buy and trade throughout the day. So that's one of the cons with the ETFs. So since it can be traded throughout the trading day, they tend to be a lot more volatile than a mutual fund or index fund. And volatile meaning they can go up and down like that pretty much. You have some ETFs that can be up 1 minute and down the next. But they all kind of operate the same. Like an ETF is kind of like a mutual fund. It's not actively managed. But you have ETFs that can have stocks, just stocks in it, just tech stocks, just oil sector stocks. You can have an ETF that has stocks and bonds and stuff like that. And a REIT is pretty much simple because a REIT just covers everything that has to do with real estate. So REIT stands for Real Estate Investment Trust. And with the REIT, 75% of its investments has to be in real estate. So you can have REITs that's in the health field. You can have REITs that cover supermarkets, parking lots, movie theaters, REITs. You want to look into them, into the holdings, which is pretty simple. And I have a video explaining in detail what these are, but this is just an overview of them. But with the REIT, one of the pros is 90% of its taxable income has to be paid out in dividends. So it's like guaranteed dividends. But that leaves 10% for growth opportunities. And the money that's left over from the REIT has to go back to managing the properties that it owns. But there's two types of REITs. You have equity REITs and mortgage REITs. And the equity REITs is pretty simple. Those are the ones that deal with actual properties. And the mortgage REITs deal with mortgage-backed securities. And then, last but not least, if you feel like single-handedly or doing your own investing in stocks and picking your stocks and picking your bonds, you can do bonds. And bonds are pretty simple. How a bond works is it's kind of like going to the bank and getting a loan, only you're the lender. So a bond is, let's say I'm the corporation and I issue bonds at $1,000 with a interest rate of 10%. So pretty much you'll give me the $1,000, and let's say the bond matures in 3 years. So every year or annually, some bonds pay semi-annually every 6 months, but annually you'll get the 10% interest, which would be $100 in this case, and then at the mature date, you'll get the $1,000 back. That's pretty much how a bond works, and they're considered a safe bet, pretty much. A lot of people say they're safer than stocks, but if I default on that bond, then you might lose your money. But you have some secured bonds that are asset-backed, meaning if I default on that bond, then I have to forfeit assets to cover that bond. And another thing about bonds is a company or a corporation is required to pay a bond back before they pay a stockholder back. Pretty much if you have a stock in a company and it goes under, you lose your money with stock. With a bond, you have some type of coverage there depending on what type of bond you have. And with bonds, you have corporate bonds, municipal bonds, and treasury bonds. So the only difference is with a corporate bond, the yield or the interest rate tend to be a little bit higher because they're a little bit riskier. With a municipal bond, since it's backed by the state or whatever local government you have, they are income tax free, meaning you don't have to pay income taxes on those and dividends. And with a treasury bond, since they are considered the safest, they have the lowest interest rates. So you might get a 1% interest rate or a 3% interest rate. And pretty much that's it in the summary. And I'll have a video for each of these coming out soon, going into detail, explaining everything you might want to look at, pros and cons, and all of that. Thank you. Thanks for watching another episode of Fayle Safe Wealth. Hopefully today you learned something or enough to go out and make some Fayle Safe investments. And good luck with your future investments and diversifying your portfolio. Let's get it. Let's do it.